Hi, I just wanted to provide an example of intercompany transactions to explain why the journal entries are the way they are. Okay, so let's get started. Let's assume that P, the parent company, sold merchandise to the subsidiary at a cost of $30,000 and a selling price of $50,000. What that means is that the merchandise that P sold to S was valued at $50,000, but the actual cost of the merchandise was $30,000. At year end, so that's part one. Part two is at year end, it seems that S sold 60% of the merchandise that was bought from P. So 60% of merchandise bought from P. What that means is that S still has 40% of the merchandise as ending inventory. Okay, so let's get to it. I think the best way to understand it is by first looking at how they recorded these transactions in their internal books and then moving on to how they would eliminate these entries. So let's get started first from P's perspective. So on P's internal records, P sold merchandise to S for $50,000. So that means P is going to debit cash for $50,000 and we're going to credit sales for $50,000. Simultaneously, we're going to have to record the inventory lost, which is $30,000. So we're going to debit cost of goods sold for $30,000 and we're going to credit inventory for $30,000. So that's P's internal books. Then what is S's internal books? Well, in S's internal books, we are going to debit inventory for $50,000 because that is the price that we bought the inventory at. We're obviously not going to price the inventory at what P value the inventory at. We're going to use the fair value, which is $50,000, because that is what we're buying the inventory for, and so that is what is going to come into our books. So inventory of $50,000, and we're going to credit cash of $50,000. Okay, so now what I like to do is kind of look at the balances, right? So right here, we have a balance of cash for 50. We have sales for 50. And we have cost of goods sold 30 and inventory negative 30, right? Because it's going in and we credited inventory. On this side, we have inventory of positive 50 and we have cash of negative 50, right? So let's look at the running balance for these two transactions. So the running balance is cash plus 50 minus 50, which is going to give us 0. We also have sales of 50. We have cost of goods sold of 30. And then we have inventory of minus 30 plus 50, which gives us 20. Okay, so now I'm going to get rid of these right here. Awesome. Okay, so the next step is to now start the elimination entries, right? So over here, we're going to look at what do we have to eliminate. We have to turn all of these balances to 0 because we have to pretend like none of this ever happened. So our cash is already eliminated. We're going to have to eliminate our sales by 50. So let's go ahead and do that. So step 1 is eliminate sales. So let's eliminate sales. We're going to debit sales for 50 and we're going to credit cost of goods sold for 50. Awesome. So now what is our running total? Well, right here, our running total now is cash of 0, sales of 50 minus 50, which is now 0. Our cost of goods sold was 30 minus 50. Now our cost of goods sold is minus 20, and our inventory is 20. So the next step would be to eliminate, step 2 is to eliminate remaining balance. So this is pretty easy. They both balance out, so we're going to debit cost of goods sold for 20, and we're going to credit inventory for 20. So now our running balance is sales is 0, cost of goods sold is minus 20 plus 20, which is 0, and our inventory is 20 minus 20, which is 0. Great. All of our account balanced. Is this the end? No. We're going to now look at this additional information that we have. So just remember that through these journal entries, we were able to bring all of our intercompany transaction balances to 0. Okay, so now let's look at the second part of our question, which says that at year end, S sold 60% of the merchandise bought from P. So this is a little confusing, so I'll try to explain it the best way I can. S sold 60% of the merchandise, correct? So on S's books, remember that S bought inventory from P at the value of 50,000. So in S's books, inventory bought from P was valued at 50,000. Well, of these 50,000, S has now sold 60% of it, right? So that means that in S's books, we debited cost of goods sold for 30,000 and we credited inventory for 30,000. And how did we get the 30,000? It's through this journal entry. We don't know how much S sold it for, and it honestly doesn't matter because S sold it to unaffiliated parties, and so we do not have to eliminate those sales because they're not intercompany transactions. These are not sales that are happening between the parent and the subsidiary. That was what was in S's books. But here's the thing. When we are consolidating, right, we assume that this is one company, not two different companies. And when we're doing such consolidations, through these entries, we literally eliminated this whole transaction. This never happened, right? This never happened. So that means that in our books, inventory is still valued at 30,000. It's not valued at 50,000 because that transaction never happened. Inventory never came into S's books for 50. We never lost inventory from P's books for 30,000. That never happened. Inventory is still at 30,000 and this 50,000 inventory does not exist. So under consolidation concept, when we're saying that, hey, this is one company, the actual journal entry that should have taken place when 60% of this inventory was sold should have been debit cost of goods sold and credit inventory at 18,000. How did I get this 18,000? Well, again, going back to what I just said, that these transactions at top never happened and we got rid of it through these elimination entries. So the inventory that we actually sold was based off of the 30,000 inventory that was valued in our books times 60%. So in reality, our inventory is actually overstated, right? We overstated our cost of goods sold and we understated our inventory, right? So how much did we overstate our cost of goods sold and inventory by? Well, it's just 30 minus 18, right? And that is 12, right? So our cost of goods sold should have been 18, but we debited cost of goods sold for 30, which is 12 over. So we're going to credit cost of goods sold for 12, and we're going to debit inventory for 12. So I'm going to get rid of this because now is where all the fun part starts, right? This is when we combine all of our journal entries together. So I'm going to move this up. We're going to debit inventory for 12, and we're going to credit cost of goods sold for 12. Awesome. Now let's look at our total balances. Let's look at our balances. Let's first look at sales. So our sales is a debit of 50. So we have sales of negative 50. Our cost of goods sold is credit of 50. So that's negative 50. Then we again debited cost of goods sold for 20. So we're going to add that 20 back. And then we credited cost of goods sold again for 12. And that leads us to a cost of goods sold of 42. And then finally, we credited inventory for 20, but then we debited inventory for 12, leading to a total inventory balance of negative 8. And over here it's negative 42, by the way. So our total balances are sales negative 50, cost of goods sold negative 42, and inventory negative 8. So when sales is negative, we debit sales for 50. When cost of goods sold is negative, we credit cost of goods sold for 42. And when inventory is negative, we credit inventory for 8. And that is our elimination entries. Now here, you will see that I kind of combined the two together. Sometimes these cost of goods sold are actually not combined together and are instead put at their at separate values. So inventory still stays 8. Here, you're probably going to bring in cost of goods sold of 12 from right here. And we're going to get rid of this 30 cost of goods sold right here. Or you can just use this as a balance, as a plug, as you might say it. But that's just kind of the explanation for how certain journal entries happen and the reasoning behind it.